Fear is one of the most profitable resources in modern finance, and most people don't even realize they're supplying it for free. Not because they are foolish, but because the system is designed to quietly reward anxiety, uncertainty, and hesitation. Banks do not need you to be reckless to profit. They need you to be afraid, unsure, and dependent. When fear shapes your financial decisions, institutions step in as stability providers, and that position is extremely lucrative. Before we go further, understand this clearly. This content is for educational purposes only. It is not financial advice. It does not replace personalized guidance from a licensed professional. The goal here is understanding behavior, incentives, and structure, not telling you exactly what to do with your money. In this video, you're going to learn how fear is monetized inside the banking system, how everyday financial products are engineered to feel like protection while quietly extracting value, and how your emotional responses influence interest, fees, and long-term outcomes. By the end, you should be able to recognize where fear is costing you money and how to start shifting from reactive safety to intentional control. Banks present themselves as neutral guardians of stability, but stability is not their product. Risk management is, and the easiest risk to manage is human behavior. When people are scared, they prioritize certainty over efficiency. They accept lower returns, higher costs, and tighter restrictions in exchange for emotional relief. That trade is the foundation of modern banking profit. Think about what happens during uncertainty: economic downturns, job insecurity, inflation headlines, currency pressure, political noise. The first instinct is not optimization, it is protection. People rush to savings accounts with low yields. Lock money into fixed products they don't fully understand. Overinsure, overborrow just in case, and avoid decisions that require learning. Each of those behaviors transfers value away from the individual and toward the institution. Fear makes cash feel safe even when it is silently losing purchasing power. Banks pay minimal interest on deposits because they know safety is emotionally priced, not mathematically priced. You are not being paid for the value your money creates. You are being compensated for your willingness to stay calm. Meanwhile, that same money is deployed at significantly higher rates elsewhere. Fear also makes debt feel like security. Credit cards, overdrafts, emergency loans, and salary advances are marketed as lifelines. And emotionally, they are. They remove immediate stress, but structurally, they lock you into high-interest, revolving obligations that benefit the lender far more than the borrower. When fear is present, the cost of borrowing becomes secondary to the relief of access. Notice how banks frame their language: peace of mind, protection, flexibility, backup, safety net. None of these words describe wealth creation. They describe emotional comfort. Comfort is expensive because it reduces resistance. People do not negotiate hard when they are afraid. They comply. They accept terms quickly. They stay longer than they should. Even savings behavior is shaped by fear. Many people are taught that saving itself is the goal, not what saving enables. So money sits idle, earning little, while inflation does its work. Banks benefit twice. They receive cheap capital and face minimal pressure to innovate for the depositor. The fear of loss outweighs the fear of stagnation. Insurance-linked banking products thrive on the same dynamic. Bundle fear with complexity, and people disengage. The more confusing a product feels, the more likely someone is to trust the institution rather than their own understanding. That trust gap is profitable. Complexity hides margins. Fear doesn't just influence what people choose. It narrows what they believe is even possible. When fear dominates financial thinking, safety becomes the primary goal, not growth. And safety, as most people define it, is the absence of short-term discomfort rather than long-term stability. Ownership is uncomfortable by design. To own something, equity, a business, an asset, you must accept uncertainty. Values fluctuate. Progress is uneven. Results arrive late. Ownership forces you to sit with volatility without immediate reassurance. Fear resists this. Fear wants certainty now, even if that certainty quietly erodes future outcomes. This is why guaranteed or fixed return products feel attractive. They offer emotional relief. They remove decision fatigue. They provide the illusion of control. But mathematically, many of these guarantees underperform assets that involve temporary instability. The trade-off is subtle but profound. You exchange long-term upside for short-term peace of mind. Banks and financial institutions understand this deeply. Their products are not designed to maximize your wealth. They are designed to optimize their balance sheets. When you choose a fixed deposit, a low-yield savings product, or certain structured instruments, the bank absorbs your capital, redeploys it into higher yield or growth-generating activities, and keeps the spread. Your return is capped. Their upside is not. This doesn't require malicious intent. It's structural. Banks exist to manage risk efficiently and generate predictable cash flows. They cannot do that if customers behave unpredictably, chasing volatility, withdrawing capital impulsively, or demanding variable outcomes. Fear simplifies human behavior. A fearful customer is conservative, compliant, and consistent. That consistency allows banks to model cash flows, hedge exposures, and stabilize earnings across economic cycles. Predictability is the raw material of financial profit. The more predictable behavior becomes, the easier it is to design systems that extract value from it. Fear compresses decision-making into narrow channels: safe, guaranteed, low risk. Once behavior fits those channels, institutions can scale products around them. Ownership, by contrast, breaks predictability. Owners don't behave uniformly. They hold through downturns or exit early. They reinvest or expand. They demand information. They tolerate variability. From an institutional perspective, that variability is expensive to manage. So fear nudges individuals away from ownership and toward products that convert uncertainty into fixed outcomes. Outcomes that are safer emotionally but often weaker financially. Over time, this creates a quiet imbalance. Institutions accumulate upside and optionality, while individuals accumulate stability without growth. The result isn't exploitation, it's alignment. Incentives reward those who can absorb volatility and penalize those who cannot. Fear doesn't just protect people from loss, it also protects systems from disruption. And that is why fear, when left unexamined, doesn't merely limit personal wealth. It reinforces structures where upside concentrates upward, predictability becomes profit, and ownership slowly transfers from those seeking comfort to those willing to endure uncertainty. The most expensive fear is the fear of making a mistake. That fear keeps people from learning basic financial mechanics. When you don't understand interest, compounding, liquidity, or risk distribution, you outsource decisions. Outsourcing decisions usually means paying a premium. Over time, fear becomes normalized. Low returns feel normal. High fees feel unavoidable. Debt feels permanent. The system does not need to trap you aggressively. It just needs to wait while fear does the work quietly. Now pause and reflect. Ask yourself where fear shows up in your financial life. Is it the fear of losing money that keeps you from investing and understanding? Is it the fear of instability that keeps you over-leveraged in short-term debt? Is it the fear of responsibility that keeps you dependent on products you don't control? Write down one place where fear, not logic, is driving your decision. Then assign yourself one task this week. Learn one concept behind that decision deeply enough that it no longer scares you. Not to act immediately, but to remove fear from the equation. This video is not saying abandon banks. It is saying stop paying fear premiums unnecessarily. When fear is reduced, negotiation improves. Choices expand. Costs shrink. If this helped you see money differently, stay with the channel. Subscribe and keep building understanding slowly and deliberately. Control grows where fear fades.